Well, welcome everybody to the September edition. It's the kind of the beginning of autumn edition of Dashboard Diagnostics. I see a lot of familiar names in the crowd again tonight. I think you're in for an interesting discussion here tonight. We are going to be talking about a club that is not named Rappahannock. They're one of the clubs that has chosen to enter our witness protection program, but they have been very open with sharing details about their portfolio, and I think it'll lead to some interesting stuff. There's a couple pictures on your cover slide of the Rappahannock River there in Northern Virginia. That is home for this particular investment club. And so is that Northern Lights picture from somewhere in the valley there in Northern Virginia. And I also wanted to put that in there because of the connection to Lori Fredrickson's home turf of Traverse City, where if she tries hard enough, she will see that in the sky sometime up there. We've actually seen that from Lake Michigan before. Our trick-or-treaters are there just to give us that nudge to remind ourselves that within the next couple of weeks, the Forbes will be issuing its list of the best 100 small companies, and it usually comes between now and Halloween. So that's just our reminder to keep a watch out as a community for that list for interesting, promising small company ideas, and it's certainly going to apply to Rappahannock tonight. So we'll start by making our lawyers happy. It's a fairly brief disclaimer. You guys know the drill. No investment recommendation is intended. We're going to be talking about real companies in real time, but it is all for educational and illustrative purposes only, and please take those words to heart. I'm supposed to ask you to leave if you don't agree with this disclaimer, so I'd hate to do that to anybody, so let's not. I thought I'd start tonight with just a real quick reminder, a couple of pictures that we actually showed off, images that we showed off at the National Convention for Better Investing in Cincinnati last week. And the reason I bring it up here is just to focus on those two major characteristics that we believe are an important part of characterizing any investment. And this one has to do with building a projected return. And basically it comes down to just an image familiar to many of you, where we attempt to build basically a model of the business, understand the business model from the top line to the bottom line, and literally take a look at those trends and relationships in order to establish a 5-year earnings forecast. We combine that 5-year earnings forecast with a reasonable and considered judgment for, in most cases, a PE ratio, and come up with a projected annual return. But the core of everything starts right here, where we're attempting to understand the trends and forces impacting the business. And again, as most of you know, that yellow shaded area just reflects the fact that we embed and take into account a couple years of analyst estimates going forward. So that becomes part of our trend, and it can be very important. Just as you can see from the graphic right there, the recovery that is shown on the right-hand side of this is certainly a powerful piece of information when you have this downtrend that you see in the midsection here. And again, the difference between the two lines, again, top line and bottom line analysis, with the difference between the two really reflecting the profitability of the enterprise that we're studying. So projected annual return is the first. And the second, we just want to hit up real quickly, it's the answer to what is the quality of the company. These are the 4 components that we use. Basically take a look, looking for a strong balance sheet, looking for consistent and reliable earnings track record and trend, and then the 2 categories at the bottom where we compare the sales growth or the top line growth forecast for the company and its profitability. Whether we're looking at net margin or return on equity, some measure of profitability. And the relative simply means that we're comparing it against peers or competitors. And we stack that up. And again, we're not going to dive deeply into the calculations other than to point out that we then basically break down the entire universe of companies that we track, approximately 2,500 companies. We divide them into 20% segments. And the top 20%, known as a quintile, the statisticians, are color-coded in blue and have a quality rating greater than 65. So we tend to focus on those in the community, and we will go down occasionally to a quality rating of 55. Anything between 55 and 65 is in that second quintile. So it's still a good company, but it basically at the lower end of that range, you're starting to approach average. And we really do like to discover industry leaders when their projected returns are high, suggesting that they might be on sale. So again, that's the quick reminder that the characteristics that we follow for any investment are the projected annual return, known as par, and the quality. So that's our quick refresher, because we're going to be tossing around those numbers here in a few minutes. Our club for tonight it's a neat club. It hasn't been around that long, but you got to really take your hat off to these ladies. 11 ladies in Northern Virginia. That is not the name of the club. That's just a general, well, it's a river in Northern Virginia, Rappahannock. I just picked that because it's fun to say. It's kind of like Francisco in the movie Elf, but it's kind of a neat name, so we picked that as their witness protection program name. In the correspondence with the club, they mentioned that it is a friends and family club, as many investment clubs are. They shared that they were launched by a very capable mentor, and that they did rely pretty heavily on value line analysis in the early days, and that they are attempting to pay more attention to prudent diversification going forward. And that's good advice for a club 3.5 years old. It's really the point in the timeline, or the age of the club, where you really should start to have some consideration of that. And we'll definitely be digging into that a little bit tonight. So let's go with Rappahannock. Here's the other thing that's really neat about the club. 3.5 years in operation. Again, they were formed right into the teeth of that huge Great Recession, that bear market. Since their club was formed, in fact, as you can see down here, the S&P 500 has actually lost ground. So it'd be real easy to get discouraged if you were invested just in the S&P 500, but we know better than that. Something else that we'll be talking about tonight. This particular club has achieved a return between 4 and 5%, which again might not seem like anything to celebrate about until you put it in perspective and say, hey, but the market's actually lost ground during this time frame. Again, this is an outstanding number. It's what we're shooting for over the long term. If these ladies continue to achieve that, plus 5% relative return, as the market over time, weaves and bobs and weaves over time, and comes in at 8 or 10%, these ladies could literally be in the 13 to 15% range over the longer term. And you can see that their performance over the last calendar year has been outstanding, and you'll see why here in a few minutes. So again, outstanding performance. Keep doing what you're doing. You're obviously picking stocks. Even if there's any luck involved, don't apologize. Just keep pressing on. Here's a quick look at the key characteristics of any portfolio. We basically counsel that these are the 3 most important characteristics for the total portfolio. And you can see now why we started to go off with a refresher as to what those 2 are. The Rappahannock portfolio right now comes in at 8 to 9% projected annual return. The weighted average quality rating for the company for the portfolio is excellent, in the mid-70s, and growth might be a little bit low. Everything else is pretty characteristic. Good financial strength that would be comparable to a kind of an average rating of A+ by value line. The lines are pretty straight when it comes to the EPS trend also. But here are the 3 major characteristics. The projected annual return of the portfolio is approximately 9% right now, with the general stock market sitting at approximately 12. We try to counsel the clubs into shooting for 17 to 22, and that's what's depicted here by this target range, 17 to 22. So as the club thinks about what type of decisions, what they might do with new cash that comes into the portfolio, some of the emphasis has to be on targeting closing that gap a little bit. The quality's fine. Keep continuing to select those high-quality companies. No problem whatsoever there. And the club mentioned diversification. We believe that size diversification by sales growth is one of the most important things you can do in investing, whether it's in a club or your individual portfolios. And we really like to see 11% plus or minus, give or take. So this is, again, just a little bit short of that, So all that is saying to me is, when evaluating future opportunities, just put a little more weight on the smaller, faster growing companies and just try to drive that overall portfolio sales growth that you see here and here also, drive that up into that 10, 11, or 12% range as a group. Just make it part of a longer term mission to take care of that. This is just a quick reminder that stock prices do fluctuate. This is the value line arithmetic average, one of the ways that we measure the stock market. Again, hats off to the ladies. They basically got involved somewhere right in this time frame in the market, just in time for this to happen. You know, wham. They stuck it out, continuing to pick good stocks throughout, and have managed to actually outperform this going over the last couple of years. Not bad at all. So if the markets fluctuate, stock prices fluctuate, projected returns are also going to fluctuate, and that's something that we've captured here. Again, just to emphasize what happens during recessions and deep corrections. These numbers were only seen 2 or 3 times over the last 50 or 60 years. Returns in the upper teens are approaching 20%. And you can see that the turbulence that we've had over the last 2 to 3 months has taken us back into a fairly elevated range where many stocks have projected annual returns that are now in the teens again. So again, you want to be shopping amongst those that are positioned to outperform the market. Here's a look at the Rappahannock portfolio. If they like shopping, they've certainly done it well. This is a little heavy, but again, for a relatively new club, you don't want to obsess over that. You want to go where you see opportunities. They have done that. And what I basically see here is I wouldn't rush out to buy more discretionary, or I would look for selling opportunities among the consumer discretionary stocks in the portfolio. You know, just looking over it quickly, a little light on healthcare. There is no on technology. There is no healthcare in the portfolio, so that's something that unless there's some allergy to the healthcare sector in the club, there can be some wonderful opportunities in healthcare also. But again, really early to worry about, but over time you want to be spreading out the sector diversification, and you probably don't want any position, you know, approaching 60 or 70%. Your top position you want to be probably somewhere in the 30%, 20%, or less, depending on the sector range in the future. But right for now, consumer discretionary stocks have been very good to them. They've benefited greatly from the last several months of strong returns within that sector. Here's a look at the portfolio, again, attempting to take a look at what we think is really the most important diversification element. Sector diversification is important. Size diversification or sales growth diversification is even more important. And you really want to divide the portfolio up into just what you've heard talked about over the years. You would really like for about a quarter of your companies to come from the small, a quarter of your companies to come from the large, and medium to fill in the rest, or the remaining 50%. So you really want to see 25, 50, 25 in this distribution. So again, the medium, and again, these probably served them pretty well. What you really want to be looking for, just as the growth has already told us, is a few more of these going forward. So smaller companies, again, we define companies as small when they are growing at 12% or more. So a company growing at 12% or more, real easy to remember. And since you're probably wondering what is large, those are the companies growing at less than 7%. Okay, so 7 and 12, you only have to remember those two numbers, and that's really what you're aiming for. You'd like to find, perhaps trade a company that's growing at 7% or less for a company that you find that's growing at 12% or more, and just kind of get that pie more into that 25, 50, 25 distribution.